Hello, fellow options traders. Steve Ganz here with another in the Compare and Contrast series. And I'll tell you that this particular session came out of the recent start to finish trade that I just completed. And I'll share a link down below, and I'll also have it pop up as the next video after this one is over. So if people did not see that, they can go and take a look at it. But basically, I entered a broken wing butterfly in SPY, and I did it approximately 30 days out. And an astute trader asked me the question, Steve, why are you doing this 30 days out? Theta decay or time decay, we can see on here. If you have the more advanced version of OptionStrat, you can see your Greeks here. And you almost have to be able to see and understand your Greeks in order to learn options trading. But this particular one here, the theta decay is approximately 80 cents a day that this thing's going to decay. However, as you get closer and closer to expiration with options, this speeds up. It'll start to go in a few days, it'll be decaying at 90 cents a day. And then a few days after that, it'll be decaying at around $1 a day. And that decay is what, lifts this what we call the T0 line, which is our line of profitability in this trade. So that theta decay, as you can see, when we get down to only 1 day remaining, look how much it's got to go. It's going to decay another $250 in that last day if the price stays right in the center of our tent. But down at the beginning here, we can see that when we put this trade on, we're decaying at, again, about 80 cents a day. We go in about, 2-3 weeks. While this number here doesn't necessarily change, we can see that 2 to 3 weeks in, we've only picked up $28. You go another weekend, and geez, we picked up $50. So you can see that decay is happening faster the closer you get to expiration. So the logical question is, well, why don't you just put on that butterfly trade a couple of days from expiration so that it decays as fast as possible? So there's a number of answers to that, and what I want to do here is I'm going to take just a second, I'm going to split the screen, and I'm going to show you a side-by-side comparison of a short-term butterfly trade versus a 30-day out butterfly trade. And I will tell you, if you like day trading, I do have occasionally I will do short-term trades, sometimes zero DTE trades, things like that. But that's very close to or akin to day trading. I have to sit here at my screen. I have to watch that thing. I'm making hundreds of decisions a minute. Do I get out of this thing? Do I adjust this thing? Well, I'm going to wait and see if the market ticks up another point or two or ticks down a point or two. Where when I put these on at, 30 days out, 40 days out, I don't have to think about that at all. I go out and I go on a bike ride, I do my walk, whatever. I come and I check in on the position an hour before the close maybe. So I'm going to pause here just a second, pull these up side by side and show you what I mean in more detail. Okay, so let's take a close look at these and let's see what's happening. These are both the exact same position, a $5 wide butterfly. So in other words, our wings are $5 wide. We are selling, in both cases, we are selling a 447 call and a 447 put. We're buying a 452 call and a 442 put, and we're 39 days to expiration. The only difference, this is the exact same trade. The only difference here is this is essentially 1 day to expiration. Now take a look at these two P&L diagrams. This is really important to understand these. Now I've got these both set, I believe. Well, let me put this range at 2.5 as well, so that the ranges in both of these are the same, just so that everything kind of looks the same on them. All right, so you can see right out of the gate, one of the biggest things that we see is here, our maximum loss is $50 in this trade. Here, our maximum loss is $220. Again, the exact same spread. So it's important to look here again, not only at the max loss, but look at the credit we're going to take in. We're going to take in $449 in credit on this 39-day trade. We're taking in $281 on this 1 day to expiration trade. Our max potential profit here is the amount we took in of the 449 versus the 283. Here we've got a 20% chance of profit. Here we've got a 51% chance of profit. Now that's a pretty big differentiating factor there. So, and the reason for that is, of course, because over a 30-day, or in this case 40-day period, the market could easily wander outside of this tent. In a day's worth of time, it's a little less likely that the market is going to wander outside of this tent. So again, it's like, well, why wouldn't you then consider a trade like this? Well, we can also look at our break-evens here. Here our break-evens are pretty wide at 442 and 451. Here our break-evens are much, much tighter. So at the end of the day, it boils down to what type of a trader are you, or what type of a trader do you want to be? The main factor here, why I don't do these short-term butterflies or any type of short-term options trades for the most part, is let's come take a look at our Greeks. And the Greeks, if you don't have the paid version of OptionStrat, you won't see these numbers here, okay? But these are numbers that, if you're going to be an options trader, you're going to have to learn these numbers, and you're going to have to know what they mean. So you really need to have the platform that will give you this information so that you can understand these. So probably the biggest factor for me personally is I don't want to have to sit at my computer and take a look at exactly what's going on in each of these trades. Now, the main number I'm going to look at here, we already talked about how theta here decays much, much faster. Here we're $66 a day, but there's only 1 day really, or day and a half in this trade. This one's going to decay at, call it 80 cents a day. So big, big difference there, all right? However, what we really need to focus on is this curved line right here, okay? Or this curved line right here. This is our T0 line, and this is our T0 line here. So the solid line represents the T0 line today. The dashed line represents the T0 line halfway to expiration. And then, of course, this dotted line here represents the T0 at expiration. Now, here again, expiration is 39 days out. So at, call it 20 days out, this is all we've really gained in that position. We've gained, what, 60 bucks, something like that. Here, halfway to expiration, which will be tomorrow morning, we will have gained significantly more. But look how steep this curve is. This is called gamma, okay? Our gamma number is much, much higher here. What that means is that if the market were to sell off to, let's say, we're right now at 445. If this were to sell off to 442, I'd be down 60 bucks. Here, if this sold off to 442, I'd actually be up a little bit of money. But the bottom line is that this move has very, very little impact on my P&L. With a longer term to expiration trade, I'm not really playing direction of the market so much, or direction of my underlying so much. I'm really playing the time decay, the theta decay. That's kind of what I'm after. We can take the opposite side of this. If the market were to go up to, let's say, 450, I'll be down $13 or $8. Here, if the market went up to 450, I'm down more than double that. I'm down $50. So the move in the underlying will have a much, much higher level of impact, both good and bad, in your P&L if you have a shorter term trade on. So that just begs the question, what type of trader are you? There's not a right or a wrong here. If you're someone that wants this to happen quickly, that you are pretty good at either picking direction in a market or picking a lack of direction in this case, and you want to put this trade on and watch it decay over a day or two, hoping that price doesn't move very much in the process, this trade can be open and closed in a 2-day time frame, potentially for a nice profit if the market doesn't move on you. If the market does move on you, ouch, it's going to hurt a lot faster. Where here, I don't have to look at my screen during the day. I was a day trader for 3-4 days full time. And while I did well at it, it's just not something I want to do personally, mentally. I'd rather get out and enjoy my day. I live here in Southern California, so I can be outside quite a bit and like to get out and bike ride the motorcycle, walk, whatever, do anything as opposed to sitting and staring at a screen. So this particular style of trade, what I look to do is I get into this trade, I ride this trade maybe halfway through to expiration, somewhere in that general range. I get in here and I try to get my 10% or so out of this trade, and I move on and I open another one. For me, this is just a lot less stress and drama. At certain points in people's life, they want more stress and drama. And not that you really want stress, but you're okay with more stress and drama. At the end of the day, you're going to have two different types of equity curves. In other words, if you plot out the P&L of all of your different trades, if you are trading this style, you will most likely have much larger swings up, much larger swings down. So that's just what this is going to yield for you. If you have some sort of announcement or something that tanks this market quickly and you're not able to get out of this trade real quickly, or you think the market starts tailing off and you're thinking, oh, it's going to bounce back, I'm not going to close this now, and then the market tails off further, you can have a very sizable loss within a day's worth of time on this trade. Here, it doesn't really make any difference what the market does. I mean, within a somewhat of a normal movement, that it's not going to impact your trade by more than $1 or $2. So you don't really have to worry about that. But you'll be in this trade a lot longer. You're going to be tying up your, in this case, I think we determined it was about $50. You're going to be tying up that $50 a lot longer than you're going to be tying up your 200 and some odd dollars over here. So again, hopefully that makes a little bit of sense. And these things that I'm sharing with you will also change based on market volatility. Now, we're not going to get deep into that here today, but when the market becomes more volatile, this is going to get a better reward to risk ratio yet. Both of these actually will. So in other words, you'll be taking less risk yet, and you'll have a higher potential reward in a butterfly. And same thing over here. If we get much higher market volatility, rather than risking $218, we might be able to get into this trade with only a risk of maybe $180 and probably have a higher reward as well. So again, these are things that you'll need to learn as an options trader, is not only how time or theta decay impacts your positions, but also how volatility will impact your positions from an entry standpoint, and how it's going to impact that trade during the life of the trade as well. So again, hopefully this was a good explanation of time and why someone might prefer a longer time period trade versus a shorter time period trade. And again, I will put the link down below to that SPY start to finish trade where we did a broken wing butterfly. And again, I had that open for a while. That was probably open, I think, about 30 days or so, but it gave me 35% profit. It was something I didn't have to look at. It was a no fuss, no muss trade. Put it on, take it off. Maybe there was one adjustment in there. I don't remember exactly. But also, when you're longer term trades are a lot easier to adjust. I don't have to think about making an adjustment on any given day. If I don't make it today, I can make it tomorrow. Again, the market usually isn't swinging so widely that it has much of an impact on this trade, where a small movement can have a big impact on this trade. That's really the takeaway here as far as time frames of trading styles. As always, please like, subscribe, give me any comments, questions down below. Thanks so much.